So you want to own JPMorgan Chase, America's largest bank, a company that moves trillions of dollars every single day. Millions of people trust it with their paychecks, their mortgages, their retirement savings, their businesses, and sometimes their entire fortunes. From the outside, it looks like the perfect business. Customers hand you their money. You lend that money to someone else. You collect interest, repeat, simple. At least that's what most people think. But here's what almost nobody realizes. Every dollar sitting inside a bank is also a responsibility. Every mortgage is a risk. Every business loan is a gamble. Every credit card is a promise that someone will eventually pay you back. And if too many people don't, even the biggest banks on earth can begin to collapse. History has already proved it. Banks worth hundreds of billions of dollars have disappeared. Some survived only because governments stepped in. Others never opened their doors again. Owning America's largest bank isn't just about making money. It's about managing risk every second of every day. By the end of this video, you'll understand how JPMorgan Chase actually makes money, why it has become one of the most powerful financial institutions in the world, how it survived financial crises that destroyed competitors, and why even a bank, earning tens of billions of dollars every year, can never afford to stop worrying. Because banking isn't really the business of money. It's the business of trust. What exactly is JPMorgan Chase? When most people hear the word bank, they imagine one thing: a building, a few tellers, some ATMs, people opening checking accounts, maybe applying for a mortgage. JPMorgan Chase is something completely different. It's not simply a bank. It's an entire financial ecosystem. Imagine one company that helps families buy their first home, issues millions of credit cards, finances multinational corporations, advises governments, moves money across continents, helps billionaires manage their wealth, trades stocks, bonds, currencies, commodities, and finances some of the biggest business deals in history. That's JPMorgan Chase. Every single day, its systems process trillions of dollars, moving through the global financial system. If those systems stopped working, businesses around the world would immediately feel the impact. This isn't just another company. It's part of the infrastructure of the global economy. Just like airports move people and data centers move information, JPMorgan Chase moves money. The business most people never see. Walk into a local branch and you'll probably see customers depositing checks, opening savings accounts, or asking questions about their debit cards. That tiny branch represents only a small fraction of what the company actually does. Behind the scenes, thousands of investment bankers negotiate billion-dollar mergers. Traders buy and sell financial assets worth billions before lunch. Cybersecurity teams defend against attacks every second. Software engineers build systems capable of processing millions of transactions without interruption. Risk analysts constantly ask one question: what happens if something goes wrong? Because eventually something always does. Banks don't prepare for perfect days. They prepare for disasters. The number that sounds impossible. Let's talk about size. Most successful businesses measure their revenue in millions. Large corporations measure it in billions. JPMorgan Chase operates on an entirely different scale. Its balance sheet contains trillions of dollars in assets. That's not money sitting inside a giant vault. It's a constantly moving network of loans, investments, cash, securities, and financial contracts flowing through the economy every second. Imagine trying to keep track of millions of customers, thousands of office buildings, countless ATMs, tens of thousands of employees, and financial transactions happening across dozens of countries all at the same time. That's the reality of operating one of the world's largest banks. The challenge isn't simply making money. The challenge is controlling something so enormous that even a tiny mistake can cost billions. Not all banks are the same. Most people think every bank operates the same way. They don't. A small community bank might focus almost entirely on local customers. Regional banks expand into neighboring states. Online banks operate without physical branches. Investment banks advise corporations and governments. Then there are financial giants like JPMorgan Chase. They do almost everything: checking accounts, savings accounts, auto loans, mortgages, business lending, credit cards, investment banking, asset management, private banking, trading, commercial banking, corporate finance, international payments. The more services they provide, the more ways they can generate revenue. But every new business line also creates new risks. More customers, more regulations. More technology, more employees. More opportunities, and more problems. Why people trust banks? Here's something fascinating. Most customers never actually see their money. Your salary arrives electronically. You tap your phone to buy coffee. You pay bills online. You transfer money with a few taps. The numbers change on a screen, and you simply trust they'll still be there tomorrow. That trust is the foundation of modern banking. Without it, the entire financial system begins to break down. If millions of customers suddenly believed their bank wasn't safe, they would all try to withdraw their money at the same time. No bank on earth, not even the largest, keeps enough physical cash available for every customer to withdraw everything simultaneously. That's because banks aren't giant piggy banks. They're financial intermediaries. They keep money moving. And keeping that system moving is far more complicated than most people imagine. The biggest misunderstanding. Ask someone how a bank makes money, and most will answer immediately. Interest. They're only partly right. Interest income is important, but it's far from the whole story. JPMorgan Chase earns money from lending, credit cards, investment banking, wealth management, asset management, payment processing, trading, financial advisory services, foreign exchange, commercial banking, and dozens of other businesses operating simultaneously. In many ways, it's less like one company and more like dozens of highly specialized financial businesses working together under one name. Understanding how each one contributes to the final profit is where the real story begins. So millions of people trust JPMorgan Chase with their money. Every payday checks are deposited. Businesses receive payments, investors transfer funds, and families add money to their savings accounts. At first glance, it looks like the bank is simply collecting cash. But here's the first surprise. The money sitting in your bank account isn't really sitting there. It's working every second. And that's where banking transforms from a simple service into one of the most profitable business models ever created. Your deposit isn't the bank's profit. Imagine you deposit $10,000. You log into your banking app, and the balance says $10,000. You assume your money is safely waiting for you, locked inside a vault and doing absolutely nothing. Reality looks very different. The bank certainly keeps enough cash available for everyday withdrawals, but the rest is constantly moving through the financial system. Not recklessly, not randomly, but carefully and strategically. Because idle money earns nothing, while working money creates income. The world's biggest middleman. Think of JPMorgan Chase as the world's most sophisticated middleman. On one side, millions of customers have money they aren't using today. On the other side, millions of people need money immediately. Families buying homes, students paying tuition, businesses opening factories, companies expanding operations, and governments financing infrastructure. The bank connects both sides. Savers earn interest, borrowers receive loans, and the bank earns the difference. It sounds incredibly simple, but managing trillions of dollars this way is anything but simple. The mortgage machine. Let's imagine a young family wants to buy their first home. The house costs $600,000. Very few families have that amount sitting in cash, so they visit JPMorgan Chase. The bank agrees to lend the money, and the family promises to repay it over 30 years. Every month, they make a payment. Part of that payment reduces the loan, and the rest is interest. Now multiply that single mortgage by millions. Every month, billions of dollars flow back into the bank quietly, automatically, one payment at a time. That's one of the largest revenue engines inside JPMorgan Chase. Business loans. Homes aren't the only thing banks finance. Imagine a manufacturing company where demand for its products is growing. It wants to build a new factory, and the project costs $200 million. The company doesn't want to spend all its own cash. Instead, it borrows. JPMorgan Chase provides financing, and in return, the company pays interest for years. The same thing happens with office towers, shopping centers, aircraft, cargo ships, energy projects, and billion-dollar corporate expansions. Behind almost every major business investment, there's usually a bank helping finance it, and every loan creates another stream of income. Credit cards. Now let's talk about one of the bank's most profitable businesses. Credit cards. Swipe, tap, online purchase, it only takes seconds. But behind every transaction, an incredibly complex financial system begins working. Suppose you spend $500 using your JPMorgan Chase credit card. The merchant gets paid almost immediately, but you may not repay the bank for weeks. If you pay your balance in full, the bank still earns processing fees. If you carry the balance, interest begins accumulating month after month across millions of cardholders. Those small charges become billions of dollars in annual revenue. A cup of coffee, a grocery trip, an airline ticket. Individually, they seem insignificant, but together they become one of the biggest businesses inside the company. Commercial banking. Now think bigger, much bigger. Imagine one of the world's largest corporations. It pays employees in dozens of countries, receives payments in multiple currencies, needs financing for acquisitions, issues corporate bonds, and manages billions in daily cash flow. Handling that level of complexity requires more than an ordinary checking account. That's where JPMorgan Chase steps in. The bank becomes the company's financial partner, managing payments, providing loans, protecting against currency fluctuations, and handling treasury operations. Every one of those services generates fees, sometimes millions of dollars from a single corporate relationship. Investment banking. Here's the side of JPMorgan Chase most people never see. Imagine two giant companies decide to merge, and the transaction is worth $40 billion. Neither company simply signs paperwork and shakes hands. Teams of lawyers, financial analysts, economists, and investment bankers spend months making the deal happen. JPMorgan Chase often serves as the advisor, helping negotiate terms, raise financing, analyze risks, and structure the transaction. For that expertise, the bank earns enormous advisory fees, sometimes tens of millions of dollars from a single deal. And that's only one transaction. Hundreds happen every year. The power of diversification. Here's what makes JPMorgan Chase different from many smaller banks. If mortgage lending slows, credit cards continue generating revenue. If business lending weakens, wealth management keeps growing. If trading has a difficult quarter, commercial banking may offset those losses. The company isn't dependent on one source of income. It's powered by many different businesses operating simultaneously. Some grow rapidly while others slow down, but together they create stability. And in banking, stability is one of the most valuable assets of all. But there's a catch. Everything we've discussed so far sounds incredibly profitable. Loans generate interest, credit cards generate fees. Investment bankers close billion-dollar deals, and money keeps flowing in. So why doesn't every bank become wildly profitable? Because earning money is only half the equation. The other half is surviving the risks. Every loan carries uncertainty. Every customer could default, and every recession changes everything. And running America's largest bank costs far more than most people could ever imagine. So the bank is making money from mortgages, credit cards, business loans, investment banking, and wealth management. From the outside, it looks like an unstoppable money-making machine. But here's the part most people never see. Before JPMorgan Chase earns a single dollar in profit, it spends billions just to keep the business running. Owning America's largest bank isn't just about collecting interest. It's about managing one of the most expensive financial operations on earth. The most expensive asset. When people think about a bank, they imagine money, vaults, gold, cash. But the bank's most expensive asset isn't money. It's people. Imagine operating a business in more than 100 countries with millions of customers, thousands of corporate clients, governments, and institutional investors. Every one of them expects flawless service. That requires an enormous workforce of bank tellers, mortgage specialists, financial advisors, investment bankers, lawyers, cybersecurity experts, software engineers, economists, risk analysts, compliance officers, data scientists, and executives. Every morning, hundreds of thousands of employees begin work, and every month they all expect a paycheck. Salaries alone cost the company billions of dollars every year. Technology. Now imagine trying to process millions of financial transactions every hour without making a mistake. One missing decimal, one failed transfer, or one software error could affect thousands or even millions of customers. That's why JPMorgan Chase spends enormous amounts building technology most customers never notice, including massive data centers, artificial intelligence, fraud detection systems, mobile banking apps, trading platforms, cloud infrastructure, and digital payment networks. Every swipe of your debit card, every mobile deposit, and every wire transfer travels through software designed to operate almost perfectly. Technology isn't just supporting the bank. Technology has become the bank. Cybersecurity. Now imagine being one of the biggest financial institutions on Earth. Hackers don't see a bank. They see an opportunity. Every day, criminal organizations, state-sponsored hackers, and cybercriminals from around the world search for vulnerabilities. They're looking for customer information, account credentials, payment systems, trading platforms, and anything they can exploit. That's why cybersecurity has become one of the bank's largest investments. Thousands of specialists monitor systems around the clock. Artificial intelligence searches for suspicious behavior. Billions of login attempts are analyzed, and software updates never stop. Because one successful cyber attack could destroy trust built over generations. Keeping the branches open. Even in a digital world, millions of customers still visit physical branches. They open accounts, deposit checks, discuss mortgages, and meet financial advisors. Every branch comes with costs like buildings, rent, electricity, security, maintenance, ATMs, insurance, cleaning, and equipment. Now multiply that by thousands of locations across the country. Every branch must operate whether it's busy or completely empty. The cost of maintaining a nationwide banking network is staggering. The invisible department. Here's a department most customers never think about: compliance. Banks don't simply decide how they want to operate. They're heavily regulated. Every loan, every large money transfer, every international payment, and every suspicious transaction must follow strict financial regulations. Governments require detailed reporting, audits, documentation, anti-money laundering procedures, know your customer rules, sanction screening, and financial crime investigations. Thousands of employees work full-time not to make money, but to ensure the bank follows the rules. They don't generate revenue, but without them the bank couldn't legally operate. The cost of trust. Now imagine a customer deposits $1 million. They're not paying the bank to store cash. They're paying for confidence. Confidence that their money will still be there tomorrow, next month, and next year. That confidence requires insurance, security, technology, auditors, lawyers, and risk management. Ironically, the product customers value most can't be seen. It's confidence, and confidence is incredibly expensive to maintain. When customers don't pay. Now let's talk about something every bank fears: defaults. Imagine a business borrows $50 million. Everything looks great, sales are growing, and profits are strong. Then a recession arrives. Customers disappear, revenue collapses, and the company can't repay the loan. Suddenly, the bank isn't earning interest. It's trying to recover its money. The same thing happens with mortgages, auto loans, credit cards, and commercial real estate. Every year, some borrowers simply stop paying. Banks know this will happen. That's why they set aside billions of dollars as loan loss reserves. Money they hope they'll never need, but prepare to lose anyway. Because lending money always involves uncertainty. Interest rates can change everything. Here's something fascinating. Banks don't completely control how much money they make. Interest rates play a huge role. When rates rise, many loans become more profitable. But higher rates can also reduce borrowing, leading to fewer mortgages, fewer business loans, and fewer home buyers. When rates fall, borrowing often increases, but profit margins may shrink. The bank constantly balances these competing forces, trying to grow without taking unnecessary risks. It's a financial balancing act that never ends. The cost of reputation. Imagine one major scandal, like millions of customer records exposed. Fraud, money laundering, or compliance failures. The financial loss would be enormous. But the reputational damage could be even worse. Banks don't simply compete on interest rates. They compete on trust. Once trust is damaged, winning it back can take years. That's why reputation has become one of JPMorgan Chase's most valuable assets. And protecting it requires constant investment. The business nobody notices. Here's the strange reality. When everything works perfectly, nobody talks about the bank. Payments arrive. Credit cards work. ATMs function. Payroll is deposited. And businesses receive financing. The financial system quietly keeps moving. Success in banking often looks boring, because the best banks are the ones customers never have to think about. So we've talked about checking accounts, mortgages, credit cards, and business loans. Those businesses generate enormous amounts of revenue, but they aren't what made JPMorgan Chase one of the most powerful financial institutions on Earth. That title belongs to another side of the company, a side most ordinary customers never see. No ATM, no bank teller, no savings account, just skyscrapers, conference rooms, trading floors, and deals worth billions of dollars. Welcome to investment banking. When companies need billions. Imagine you're the CEO of a global airline, where business is booming and you want to buy 150 new aircraft. The total cost is $18 billion. Very few companies keep that much cash sitting in a bank account. So where do they go? Not to an ordinary bank branch. They call JPMorgan Chase. Instead of lending all the money directly, the bank designs an entire financing strategy. Maybe part of the money comes from investors, part comes from corporate bonds, and part comes from syndicated loans involving several banks. For organizing everything, JP Morgan earns enormous advisory fees. Sometimes one transaction generates more revenue than a small business earns in years. The business of mergers. Now imagine two technology companies, where one wants to buy the other for a purchase price of $60 billion. The deal sounds simple, but it isn't. Lawyers review thousands of contracts. Economists analyze future earnings. Risk specialists search for hidden liabilities. And investment bankers negotiate every detail. Months of work pass before a single signature appears. If the acquisition succeeds, JP Morgan Chase receives another massive advisory fee. And the bigger the transaction, the larger the reward. The trading floor. Now picture something completely different. A room filled with giant computer screens, hundreds of traders, and thousands of numbers changing every second. Stocks, bonds, currencies, oil, gold, government debt, and interest rates. Every second prices move. Some rise while others fall. JP Morgan doesn't only help customers buy and sell investments. It also provides liquidity, matching buyers with sellers across global markets. Millions of transactions happen every day, each one earning tiny fees. Individually, they're almost invisible, but together they generate billions of dollars every year. Foreign exchange. Here's something people rarely think about. Money has to travel. Imagine an American company buying machinery from Germany. The buyer pays in dollars, the manufacturer wants euros. And somewhere in the middle, someone must exchange one currency for another. That someone is often JP Morgan Chase. Now multiply that process millions of times every single day. Businesses importing products, airlines buying fuel, governments making international payments, and investment funds purchasing overseas assets. Currency never stops moving, and neither does the bank. Managing the wealth of billionaires. Not every customer visits a local branch. Some arrive by private jet. Imagine someone worth $5 billion. They're not asking about a checking account. They're asking how to preserve wealth for generations, how to reduce taxes legally, how to invest across dozens of countries, how to protect family assets, and how to create charitable foundations. This is private banking. JP Morgan assigns entire teams to wealthy clients, including investment specialists, tax experts, estate planners, lawyers, and portfolio managers. These relationships can last decades, and one wealthy family may generate millions in annual fees. Asset management. Now imagine, you're responsible for a pension fund, where millions of workers depend on you. You need professionals to invest billions of dollars responsibly. That's where JP Morgan Asset Management enters the picture. The company manages investments for retirement funds, insurance companies, universities, charities, and wealthy individuals. Stocks, bonds, real estate, infrastructure, and private investments. The bank earns management fees based on the assets it oversees. Whether markets rise or fall, those fees continue flowing, creating another stable source of revenue. When markets panic, here's where things become interesting. Imagine global stock markets suddenly begin falling. Investors panic, news headlines predict disaster, and trading volume explodes. People rush to buy while others rush to sell. Ironically, periods of market volatility often create more business for major financial institutions, more trading, more hedging, more advisory work, and more financing. Fear creates activity, and activity creates revenue. But it also creates risk. Because when billions of dollars move quickly, mistakes become extremely expensive. Managing risk. Here's something that surprises many people. The smartest bankers aren't trying to predict the future. They're trying to survive it. Every major decision begins with one question: what could go wrong? What if interest rates suddenly double? What if housing prices collapse? What if oil prices crash? What if a major corporation defaults? Or what if another financial crisis begins tomorrow morning? Teams of economists, mathematicians, and risk analysts constantly run simulations, not because they know disasters are coming, but because they know eventually something unexpected always happens. Preparation is part of the business. Artificial intelligence changes everything. Now another transformation is happening: artificial intelligence. AI isn't replacing bankers overnight, but it's changing how they work. Algorithms now detect fraud within seconds. AI analyzes loan applications, predicts credit risk, identifies suspicious transactions, helps financial advisors understand market trends, answers customer questions instantly, and processes enormous amounts of financial data faster than any human team. The goal isn't replacing people, it's making better decisions faster. For a company processing millions of transactions every day, even saving a few seconds on each decision creates enormous value. One company, many businesses. At this point, it's easy to forget we're talking about one company. Checking accounts, mortgages, credit cards, corporate lending, investment banking, trading, asset management, private banking, international payments, foreign exchange, and financial advisory. Each business could be a successful company on its own. Together, they form one of the most diversified financial institutions in history. That's why JPMorgan Chase doesn't rely on one source of income. If one division slows, another often accelerates. Diversification isn't just a strategy, it's protection. Transition to part 5. But here's the uncomfortable truth. No matter how diversified a bank becomes, no matter how advanced its technology, no matter how experienced its executives, there's one thing it can never completely eliminate: risk. And history has shown that when banks underestimate risk, the consequences can shake the entire global economy. In the next part, we'll explore financial crises, bank failures, government regulations, and why even JPMorgan Chase is never truly safe. So after everything we've covered, there's one question left. If JPMorgan Chase earns money from so many different businesses, why doesn't every bank become this successful? Because banking isn't just about making money. It's about surviving. And history has proven that surviving is much harder than growing. When confidence disappears, imagine waking up tomorrow morning and reading a headline: a major bank may be in trouble. You don't know if it's true, but thousands of other people read the same headline. By lunchtime, customers begin withdrawing money. And by evening, billions of dollars have left the bank. Here's the frightening part. A bank can fail even if most of its loans are perfectly good. Why? Because confidence disappeared first. Banking is built on trust. And once trust disappears, everything else starts falling apart. The financial crisis. To understand why regulators watch banks so closely, we have to go back to the global financial crisis. Banks across America had issued enormous numbers of risky mortgages. For years, housing prices kept rising, and everyone believed home values could only go up. Then they didn't. Millions of homeowners couldn't repay their loans. Mortgage-backed investments collapsed, and banks suddenly realized many of their assets were worth far less than expected. Some institutions disappeared completely, while others required emergency government support. The crisis changed banking forever. Why JPMorgan survived? While many competitors struggled, JPMorgan Chase remained one of the strongest institutions. That didn't happen by luck. The bank had stronger capital, better liquidity, and more diversified sources of income than many of its rivals. During the crisis, it even acquired struggling financial companies, expanding its business while others were shrinking. The lesson was simple: strong balance sheets become most valuable when everyone else is weak. The regulators are always watching, because banks hold people's savings. Governments don't simply trust them to behave responsibly. They supervise them constantly. Every major decision, every large acquisition, and every capital requirement faces regulatory oversight. Banks must prove they can survive severe economic shocks. What if unemployment doubles? What if the stock market crashes? What if interest rates suddenly spike? Or what if millions of borrowers stop paying? Every year, regulators conduct stress tests. Think of them as financial fire drills. The goal isn't predicting the future, it's making sure the bank could survive it. Capital, the invisible safety net. Here's a word you'll hear often in banking: Capital. Think of capital as the bank's financial cushion. If unexpected losses appear, capital absorbs the damage. The larger the cushion, the safer the institution. That's why JPMorgan Chase keeps hundreds of billions of dollars in high-quality capital. Not because shareholders enjoy idle money, but because regulators require strength and because customers expect stability. Cybercrime, the new battlefield. Years ago, banks worried mostly about robberies. Today, the biggest threats arrive through the internet. Cybercriminals constantly search for weaknesses using phishing attacks, ransomware, identity theft, and payment fraud. Every second, millions of digital transactions move through JPMorgan's systems. Protecting those transactions requires enormous investment like advanced encryption, artificial intelligence, security analysts, and threat monitoring. Some of the bank's most important employees never meet a customer. They spend every day defending the digital vault. Interest rates can change everything. Here's another challenge: interest rates. When central banks raise rates, borrowing becomes more expensive. Mortgage demand slows, business loans decline, and consumers spend less. But higher rates can also increase the money banks earn from certain loans. It's a balancing act. Move too far in one direction and profits suffer. Move too far in the other and economic growth slows. Bank executives constantly adjust their strategy, trying to stay profitable in changing conditions. The competition never stops. JPMorgan Chase isn't only competing with banks anymore. It's competing with technology companies, digital payment apps, online lenders, financial technology startups, cryptocurrency platforms, and artificial intelligence. Every innovation changes customer expectations. People want faster payments, instant approvals, better mobile apps, and lower fees. The bank invests billions every year in technology not because it wants to, but because standing still means falling behind. Why size can be an advantage. Some people ask why the biggest banks keep getting bigger. Because scale creates efficiency. A cybersecurity system protecting 90 million customers doesn't cost 90 million times more than protecting one customer. Technology expenses spread across millions of users. The same happens with research, fraud detection, mobile banking, and payment infrastructure. Large banks spend enormous amounts, but they also serve enormous numbers of customers. That scale becomes a competitive advantage. The real product, after everything we've discussed, loans, credit cards, investment banking, wealth management, there's one thing connecting all of them: trust. Customers trust the bank with their salaries. Businesses trust it with payroll. Governments trust it with financial markets. And investors trust it with retirement savings. Without trust, none of the products matter. The buildings, the technology, and the employees all exist for one purpose: to protect confidence. Because confidence is the real currency of banking. Looking toward the future of banking won't be defined by taller buildings or larger bank branches. It will be defined by software, artificial intelligence, digital payments, real-time fraud detection, cloud computing, and quantum-resistant security. Banks of the future may look less like traditional financial institutions and more like technology companies that happen to manage money. JPMorgan Chase understands that. That's why it continues investing billions into innovation while protecting the stability that made it successful in the first place. Transition to the final part. So can owning JPMorgan Chase make investors extraordinarily wealthy? Absolutely. But not because it's simply a bank. It's because it has become something much larger. A financial ecosystem touching nearly every corner of the global economy. In the final part, we'll bring everything together and reveal the real economics behind owning one of the most powerful financial institutions in the world. So after everything we've explored, millions of customers, billions of dollars in loans, investment banking, credit cards, wealth management, there's still one question left. If banking is so heavily regulated, so competitive, and so risky, why do investors continue buying JPMorgan Chase stock? Because they're not simply buying a bank. They're buying a machine designed to generate cash year after year, through almost every part of the global economy. A business that never sleeps. Think about your day. You wake up and buy coffee with a credit card. Your salary arrives through direct deposit. You pay your electricity bill online. You transfer money to a friend. You shop on Amazon. You invest for retirement. Your employer borrows money to expand. Somewhere a bank is involved in almost every one of those transactions. Not because it owns your money, but because it owns the financial infrastructure connecting everything together. The modern economy never sleeps. And neither does JPMorgan Chase. The power of scale. Imagine opening a small neighborhood bank where maybe you serve 5,000 customers. Now compare that to JPMorgan Chase with tens of millions of consumer accounts, thousands of corporate clients, governments, universities, hospitals, investment funds, and Fortune 500 companies. The larger the network becomes, the more valuable. It is because every new customer creates opportunities to sell additional services. A checking account today, a mortgage tomorrow, a credit card next year, and an investment account later. One relationship can generate revenue for decades. The dividend machine. Here's something long-term investors love: dividends. When JP Morgan earns profits, it doesn't keep every dollar. Part of those earnings is returned to shareholders. Imagine owning shares for 20 years. Every few months, another dividend payment arrives, then another, and another. Over time, those payments can become a significant source of income, especially when combined with rising stock prices. This is why many pension funds, retirement accounts, and institutional investors hold JP Morgan shares for decades. They're investing, not trading, buying back its own shares. The bank has another powerful tool: share buybacks. Instead of paying every dollar as dividends, the company sometimes buys back its own stock. Why does that matter? Because fewer shares remain in circulation, meaning each remaining share now represents a slightly larger ownership stake. If profits continue growing, earnings per share often increase, and investors generally reward that with higher valuations. It's another way long-term shareholders benefit. Why Warren Buffett loved big banks. Many legendary investors have spent years investing in major banks, not because banking is exciting, but because strong banks often produce consistent cash flow. They benefit from economic growth. Businesses borrow more, consumers spend more, investments increase, payments grow, and the entire financial system becomes more active. Large banks participate in nearly every step. And when the economy expands, they usually expand with it. Can someone really own JP Morgan Chase? Here's an interesting thought. No single person truly owns JP Morgan Chase. Instead, ownership is divided among millions of shareholders. Some own one share, while others own millions. Large investment firms, retirement funds, mutual funds, insurance companies, and individual investors all own pieces of the company. When the bank succeeds, they share in the rewards. And when profits decline, they share the losses. That's how public companies work. Ownership is distributed across the world. The future of banking. 10 years from now, your bank may look completely different. Artificial intelligence could approve loans within seconds. Fraud detection may become almost instantaneous. And payments could settle globally in real time. Digital identities, biometric authentication, and advanced encryption may replace many traditional banking processes. Physical branches could become less important while software becomes more important. Banks aren't disappearing. They're evolving. And the institutions adapting fastest are likely to dominate the future. The biggest lesson. Most people think banks make money by storing cash. They don't. Money sitting in a vault doesn't create wealth. Movement creates wealth. Every loan, every payment, every investment, every credit card purchase, every international transfer, and every corporate acquisition adds up. The faster money moves, the more opportunities a bank has to earn revenue. That's the hidden engine behind modern banking. Final verdict. So can owning JP Morgan Chase make you rich? Yes, but probably not for the reasons most people imagine. The real wealth doesn't come from one spectacular deal or one lucky investment. It comes from building one of the world's most trusted financial ecosystems, where millions of people and thousands of businesses choose to move their money every single day. That's what makes JP Morgan Chase extraordinary. Not one product, not one customer, not one country, but an interconnected financial network that quietly powers a large part of the global economy. The next time you swipe your card, send money online, finance a home, or invest for retirement, remember this. Behind those simple transactions, there's an incredibly complex financial machine working every second, processing billions of dollars, managing risk, protecting trust, and helping keep the global economy moving. The buildings may look like ordinary offices, and the app on Your phone may seem simple, but behind the scenes, one of the most sophisticated businesses on earth is constantly at work. And that's the real economics of owning JPMorgan Chase. The end.